Hello everybody and welcome to part 2 of our Module 15 discussion for the Managerial Accounting Special Decisions. In this part 2, we're going to wrap up a couple of additional special decisions that companies would see and need to be able to analyze. So the next one we have here is the outsourcing or make or buy special decision. And the idea here that, the term outsourcing, we're basically saying this company maybe in the past has historically made a certain component for their overall product, and now they're considering buying that component from an outside party. They'll still make the product overall, but maybe they're buying a piece of it from an outside party, or they're outsourcing services, or whatever the case may be. So again, the idea here is they can either make that component part internally or purchase it from the external supplier. So there are a variety of reasons why a company would even consider outsourcing instead of making it internally. First of all, they might no longer be able to maintain the necessary resources internally. Maybe they don't have the right skilled labor. Maybe they no longer have the right equipment, or they would have to enhance their equipment and they don't want to invest in it. They might be looking to free internal resources up for other purposes. So they're going to start producing something else that they think is more profitable, and they want to outsource this particular component to another party. They might be able to take advantage of specialization of other companies. So if you think about computer manufacturing, you think about any of the big brands, HP, any of the big brands there. Generally speaking, they do not make every piece that goes into that computer. And I really don't know of any company that makes every single thing that goes into the computer. They buy the chips from one company, they buy the processor, they buy the monitors, the keyboards from all the different companies, and then they package it, along obviously with the software that for the most part comes from Microsoft for Windows. So they package all those things together. If you had a company trying to be the best at every single thing related to computer manufacturing, that's a very tough thing to do. It'd be virtually impossible, I would say. There are so many expert companies in those various fields, the best chip manufacturers, all of that. So they're taking advantage of the specialization of other companies, letting them do what they're best at, and then this company will package those pieces together into one. It really allows them to improve their focus on what they are best at, which might just be the packaging of that product and the sales, the support, all of that, instead of them trying to dilute their focus, spread their focus way too thin, spread their efforts way too thin, and fail pretty miserably in some cases. So in addition to quality, being the best quality at all those different things, it would be extremely difficult to do that and actually be efficient at it. So by taking advantage of specialization, those other companies have probably been able to reduce their costs to a pretty minimal level. Yes, they have profit built in when they sell the parts to this computer company, but even with that profit, their charge to us is probably less than the cost we would be able to get down to if we were trying to do everything ourselves. So this may just be a way to reduce operating costs. So let's take a look at an outsourcing example here. We have variable costs per unit of $3 for direct materials, $1 for direct labor, $2 for variable overhead, and $1 for variable selling, general, and administrative. For the fixed overhead, it's $20,000. For the fixed selling, general, and administrative, it's $8,000. So notice that if we just add up the variable costs, we have $3, $5, $6, $7 of variable costs, plus the fixed costs again. Let's say the external supplier has offered to supply this component part for $9 instead of what we're currently paying, but outsourcing would eliminate $2,000 of these fixed expenses per month, but the key thing is not all of it. And by the way, let's assume that all of these costs right here relate to this particular division that's producing this product or this part. So we're going to be able to eliminate $2,000 of fixed expense, but not all of it. we're normally operating at 4,200 units per month production. So we have to take a look at the two options. Option 1, continue to make internally. Option 2, purchase it externally. Now this goes back to what we focused on at the very beginning of part 1, relevant costs. What costs are relevant to this decision? In other words, the decision between these two alternatives, make it internally or purchase it, outsource it. We only want to consider the costs that are relevant, the ones that will change. So let's look at option 2 first, because that's an easy one. The purchase price from the external vendor will only exist if we take option 2. So that's definitely relevant. 4,200 units times $9, that would cost us $37,800. There are no additional costs if we choose the purchase option. No additional costs that would only exist under option 2. Let me specify that. Under option 1, we're only looking at the costs that only exist if we continue option 1. We're not looking at costs that would be there under either option, under both options together. If they're going to be the same cost under both options, we ignore it from both lists. That's the idea. So the direct materials would only exist if we continue to make it. Same with direct labor and variable overhead. 4,200 units times the respective costs. Those would only exist if we make it internally. Now the trick here is with the fixed overhead. Let's go back a bit. We had a total of $28,000 of the two different types of fixed overhead. And we said outsourcing would eliminate $2,000 of the fixed expenses, but not anything else. So all of the other fixed expenses are going to exist under either alternative. It's only the $2,000 that's going to be different. If we continue to make internally, we do not get rid of this $2,000 of fixed overhead expense. And therefore, this is an opportunity cost. We do have to continue to incur this cost if we choose option 1, because we gave up the opportunity to save this cost by not choosing option 2. So this $2,000 cost only exists with option 1. The other $26,000 exists under either alternative. Now I will say, this is the shortcut approach, excluding those other costs. It would give you the same overall results. In other words, which one's better and by how much, if we included all of these costs. Either way, it's going to be there. It's going to give you the same difference. So if I have another line for $26,000 of fixed overhead here and $26,000 of fixed overhead here, we're still going to get the same difference of $2,000 savings. Obviously, both numbers will be bigger, but the difference will be the same. That's the point. So that $2,000 is really what saved us here. That's what made option 2 better. We're going to spend less money by going with option 2 than if we continue to make internally. So again, the alternative analysis, I said we know the variable per unit costs. We could have identified a fixed cost per unit by dividing these by the number of units, and it would have then we could compare the per unit cost. In other words, this $2,000 that's going to be different, take that divided by the 4,200 units to get a cost per unit, and then compare that total unit price to the $9 purchase price. We would have been able to make the analysis that way as well. So now we're going to move on to the discontinue segment option or alternative decision. This is sometimes known as keep or drop a product line or keep or drop a segment. But for this one, we need to take a look. Again, by the way, fixed costs are generally going to be what drives this decision as well. What costs are truly reduced if we drop a segment? Does the cost reduction from getting rid of that segment offset the revenue reduction? Because if we drop the segment, we're losing both the good and bad things about that segment. And by segment here, I'm referring to division. So let's take a look at the total company in this case. They have sales minus variable expenses, gives us our contribution margin, minus fixed expenses, give us our operating income. The total is broken into the three divisions. Now the thing I want to point out here, if you first look at it, Division A and B look profitable. Division C is losing $24,000. So that's what is driving this decision. They're considering eliminating Division C because it looks unprofitable. And they think it'll help Division A and B, or actually it'll help the overall company by losing this negative $24,000. But we have to do some further analysis to see if this is truly what's going to happen. What we have to remember is that some of those fixed costs don't disappear with the segment. So some of these, for example, this $184,000 fixed cost for Division C, some of that will still exist even if we drop Division C. And that's where the problem lies. We need to take a look at what amount of those fixed costs really relate just to Division C, and which of the costs were just allocated from the overall company to the three divisions, and they'll still exist even if we get rid of Division C. So we need a breakdown. Notice we have $1.128 million here. It's the same total fixed expenses we had to begin with. Now we're just breaking it out between direct and allocated. We're doing it for all three divisions. And what we're going to find out is that there are $64,000 of fixed expense that gets allocated Division C that'll still be in the entire company even if they get rid of Division C. So this is where the problem is. There are $64,000 of fixed expenses, but we only have a $24,000 loss. What that tells us, if we look at the contribution margin, $160,000, that's how much Division C is contributing to covering fixed expenses in total. 120 of that goes to their own fixed expenses, but they still have 40 additional thousand that's going to help cover the company's allocated fixed expenses. So even though they're not covering everything that the company would like them to cover, they're covering some of the fixed expenses that would otherwise need to go to Division A and Division B. So this division, even though it may not look profitable when we talk about net income, it is profitable from a margin, a segment margin perspective. That's the difference here. They are contributing enough to cover their own fixed expenses plus some of the entire company. For that reason, we would want to keep this segment. We might want to make some changes to try to get them to improve a bit, but we would want to keep the segment. And now we'll get into the scarce resources decision. This is one that's even more common, especially in this day and age, the past few years with the supply chain issues. We see a lot of scarce resources, whether it be labor or parts, across the country and really across the world. Hopefully we're getting in a better place, but this type of decision still needs to be made. So we're back to contribution margin, and we know that this is important in any decision regarding profit. We know we have sales revenues minus variable costs. That gives us contribution margin. And the purpose of that term is that that margin contributes to covering fixed expenses, and then whatever leftover amount is profit. So when we have a multi-product firm, which most companies are, very few companies can survive selling one product and that's it. So normally, under normal circumstances, we would maximize the production of the most profitable unit we have in total, but up to the demand. If, most products don't have unlimited demand. It's not like we can just keep producing more and more and more and they'll sell. There's a limit, countrywide, worldwide, how many people want our product. So whatever our demand is, we would maximize production of the most profitable unit up to that product's demand. Then we'd switch to the next most profitable product and keep going through that cycle. There's no use producing more than what is demanded, of course, other than a little bit of safety cushion, safety stock, if you will. to make sure we don't run out, but that's about the only reason you might produce more than what is demanded. So now we need to dig into the heart of this problem. What really is the most profitable unit? Let's say we have product A that has sales of $150 and variable costs of $80. Product B has sales of $125 and variable costs of $40. And then let's say we have shared fixed expenses of $5,000 in total. If we just were looking at revenue, we would say product A has the most revenue per unit, but that does not mean it's the most profitable. And that's a very key thing to understand. You cannot just look at your product prices and say this one's the most profitable. It's the highest priced, but it also has the highest costs, so we need to do further comparison. When we dig down to the contribution margin per unit, we'll see that it's actually product B that's the most profitable contribution margin wise. Product A, yes, it has a higher sales revenue of $150, but it has a higher cost of $80. It only gives us $70 contribution margin per unit. Product B, it has a $125 sales revenue minus a $40 variable cost. That gives us an $85 contribution margin, which is highest. So under normal circumstances, product B is the one we want to produce the most of. Let's say the demand for product A is 1,000 units. Demand for product B is 750 units. As I said earlier, we would choose the most profitable product contribution margin wise and maximize the production of that up to demand. And then we'd go produce the product A, which is second, well, it's the least profitable in this case. We want to focus on the ones that are the most profitable first. So now let's take a look at the situation that a lot of companies are dealing with right now in the country, in the world. This is the idea of we have scarce or limited resources for certain things. So this could be hours of specialized labor, could be a certain supply of a raw material, a scarce raw material, and it could be processing through a specialized machine. We don't have the equipment to produce the demand, or we're not tooled properly for that at this point in time. In this situation, it's no longer the contribution per unit of product that we're focusing on. Instead, it's the contribution margin per unit of that scarce resource. For example, hours of machine time, hours of labor, pounds of materials, feet of materials, whatever we're talking about, whatever is scarce, that's what we're concerned about. So let's take a look at the example here. Let's assume that the limited resource is the use of a specialized piece of machinery. Product A only requires 1 hour of machine time. Product B requires 2 hours of machine time. Total production would require 25 hours of machine time, and we could take a look at that by looking at product A with its 1,000 units of demand, taking 1 hour apiece. That's 1,000 hours. Product B with its 750 units of demand, taking 2 hours. That's 1,500 hours. We would need 2,500 hours of machine time. Let's assume we only have 2,000. So we don't have enough to meet our full demand. That's the problem. So which units do we focus on? In this case, we remember that product B had the highest contribution margin per unit. It had 85 versus 70, but product A, to get that $70, it only takes 1 hour of machine time. Product B, to get that $85, took 2 hours of machine time, and this is where the problem is. Which product should we focus on first? And furthermore, how many units of product A and B should we produce with our limited resource? So as I said earlier, the contribution margin per unit is no longer an issue. Instead, it's the machine hour in this case. That's the scarce resource. Contribution margin per machine hour. So we go back to the calculated contribution margin per unit, 70 and 85, but now we have to divide them by the number of hours it takes to get that contribution margin, and we find that product A has $70 per machine hour, because it only took 1 hour. Product B, if we take that 85 divided by 2 hours, it gives us $42.50 for every machine hour we use. Now that we know we're focused on what we get out of each hour, we need to focus on product A because it gives us more contribution margin per hour. But again, we want to focus on that up to its demand. Only up to the number of units demanded, then we shift to product B. So product A's demand is 1,000 units. So we're going to produce 1,000 units of product A, which only use up 1,000 of our 2,000 machine hours. We still have 1,000 left for product B. The product B demand is 750 units, and since it took 2 hours per unit, that would take us 1,500 hours to complete, and we just don't have that. We only have 1,000 machine hours left, so we divide that by the 2 hours per unit, we can only produce 500 units of product B. That is the maximum profitability we could get out of these 2 units with this scarce resource. That takes us to the end of our part 2 of this Module 15. Now this Module 15 wraps up our discussion of the MBA version of Financial and Managerial Accounting. This is the end of our 15-week course. Now hopefully you've enjoyed the materials. Hopefully you've found a little bit of information that's interesting. Hopefully it's helped to clarify some topics for you in the past. Now notice I do have other videos out there, other courses I'm preparing. So I look forward to talking to you in those videos. Thank you for your time.